Now, the financial services sector has given investors a 14% return year to date. Stanlib's Financial Fund invests in ordinary shares of companies whose businesses involve the provision of insurance and financial services to achieve long-term capital growth. Joining us in the studio to share their investment strategy, Lebogang Molebatsi, financial analyst at Stanlib. Lebogang, thanks very much for your time. Let's jump straight to the top pick in your sector.
Sure.
And it has changed recently from FirstRand to now Absa. So why the change? What is spurring your interest in Absa?
Yeah, I think the sector overall on a one-year rolling has had a very good run. It's actually up 25% one-year rolling. But if you look intra-sector, so if you look at FirstRand's performance relative to an Absa, FirstRand has really outperformed strongly. So a year ago we were very positive with FirstRand, and we effectively had a massive overweight in the FirstRand stock. But recently, you know, the stock has run very hard, and we still continue to see fundamental value in Absa relative to
So you've basically done a switch at this stage?
Effectively, we're thinking that at these levels, where FirstRand is at 27 Rand is all-time highs, it's done very well for us, but we think that there's probably a bit more value that's being offered by Absa.
Okay. Lebogang, the big thing with Absa 5-6 years ago was its exposure to the consumer sector and private property. Is that one of the attractions for you in terms of that exposure relative to the likes of FirstRand and Nedbank?
Yeah, so we're fundamentalists, so we look at stock-specific, bottom-up type research, and we think that the market is mispricing the risks around Absa. So to your point, you're right. So it is a massive retail business, and that's where they've got a massive sort of competitive advantage in our view, given the distribution frameworks, distribution footprint, etc. But the market has been concerned around specific issues around Absa, which we think is began to be priced in and is a bit overdone at these levels. So yeah, we like the fact that it's a retail business. We like the fact that Absa Capital is going to benefit massively from its relationship with Barclays. So we definitely do think that the market is being way too penal around the potential risks at Absa.
What about the broader relationship, the Absa group with Barclays group and their strategy for the African continent?
Yeah.
Have you got clarity on that?
Yeah, so obviously Barclays is a controlling shareholder, as we all know, and they've been quite vocal around the One Absa, One Africa strategy. We met with Bob Diamond a couple of months ago, and they're very clear in terms of where they're trying to take the group in the medium term, trying to make sure that Absa captures its fair share in the space outside of South Africa. So we buy into that long-term strategy. We buy into the fact that it's going to be a considered approach versus sort of going out there and trying to buy big assets that could be massively dilutive to shareholder returns. So we think the overall strategy and how it's being implemented, and Maria overseeing it, we see that as in a positive light. But I think also from in a shorter term point of view, we think that, you know, given the macro outlook and interest rates, etc., we think that Absa is well positioned because we're not seeing a massive spike in the interest rate environment, and I think Absa is well positioned in that regard.
You're not worried about the risk that Barclays controls Absa's margins the way that Vodafone controls Vodacom's margins?
Yeah, look, it is a concern, and I do think that a lot of commentators in the market have raised that in terms of saying, you know, is the strategy being set out of London and not out of Joburg as it should be? We're quite comfortable that there's enough oversight at board level, etc., that minority shareholders' interests will be looked after. And I think, you know, Absa does offer fundamental value. It's offering good returns, and I think the return to shareholders will be improving in the medium term. So we think that there's quite a lot of value to be had.
Where does Nedbank lie in the whole financial debate?
Yeah, so Nedbank's share price also has been quite strong. We've done very well from that position as well. We think Mike Brown is doing an excellent job in running Nedbank, and we buy into the turnaround story in the retail business within that business. So we are positive on it. We think that it has run hard, so it's probably not as cheap as it was obviously 12 months ago, but we still think fundamentally the story is still there.
And then, of course, we've got to move to, if you don't mind me jumping, I promise you can have two questions in a row, but to African Bank, to Able.
Yeah.
In terms of the micro-lending space, the big debate around unsecured lending, how do you feel about Able?
Yeah, so unsecured lending has been growing at 35% plus for the last 12 months or so. And we've seen all the big banks coming into the space quite strongly, excluding Absa. So Absa has probably lagged in terms of market share in the unsecured lending space. But be that as it may, we think unsecured lending in South Africa still has got strong legs. And we, on a 2 to 3 year view, we do think that growth will still be strong in that space, especially because the secured lending space is slowed materially, particularly the mortgage product. So we are positive on that. We think that Able is extremely well positioned there. They've demonstrated the ability to underwrite in that space better than anybody else. So we buy into that, and we think that they'll benefit. Having said that, there are concerns around, is unsecured lending in South Africa growing too quickly? We think we're coming from a very low base, and we'll really start getting concerned maybe if these growth rates continue for another year and a half.
Speaking on unsecured lending, Capitec is one of those that have grown fairly aggressively in unsecured lending. It's almost moving into the same space that Able has, or Able is right now. Do you see it starting to hit a ceiling?
No,
and perhaps talk to it relative to African Bank as well.
Yeah. So there's no question that Capitec has disrupted the market, not only Able's market, but even the Big Four market. I think the Big Four would probably admit that they probably underestimated Capitec's abilities and allowed them to take market share. So Capitec has done extremely well, and the share price has reflected that. So we do think, though, that at the current levels, we doubt whether Capitec will be able to maintain the current growth rate, not necessarily in the book, but the earnings growth profile. I think what the market is expecting out of Capitec on a 3-year view is a bit rich in our view. And we think that you can have that in Able. So they do have very different funding models, and we understand that. But we would much rather have an Able at the current valuations than a Capitec.
And you like the Ellerine strategy. We are running out of time, but just on Able, the Ellerine strategy, how are you feeling about that?
Yeah, so we think that the team at Able has done a relatively good job at turning around Ellerine. It did take a little longer than I guess we were all hoping for. But the market didn't work in its favor. Yeah, no, fair enough, exactly. So, and they probably overpaid for the asset, but in hindsight,
science, isn't it?
100%. So we think that the outlook now for Ellerines is definitely good, and they should be able to compete.